as I was saying, every trader's dream should constitute, I'm drawing this in a very simplistic manner. Number one, you have to have some idea, you don't have to, but it does help, if the trend is up, down, or sideways. And that's why on the checklist that we are giving you, we'll show you that question number 7 at the bottom is the trend up, down, or trendless. Let me zoom a little bit in there. There we go. Is the trend up, down, or trendless? No matter what methodology you use for defining the trend, I really don't care if it's my method, your method, or a method that you have learned, that you're happy with, as long as you know what is your trend definition. The majority of money is made by traders who A, define the trend, and B, have a tool, a methodology, a concept, a way to get into the market in the direction of the trend. In other words, they will look to buy. Once they establish that the trend is up, they will look for a way to buy the dips in the direction of the trend. And surprise, surprise, if the trend is down, that's not going to do it. Still up. Tells you something. The trend is down. They will find a way or a method that will enable them to sell the rallies. In those areas here, if you learn how to do this, you are made as a trader for the rest of your life. Partially, the zones will be able to help you to do this because it will show you, as we're going to see, that if you have a downtrend and the resistance in the particular zone pattern that sets up gives you a 60% or more, we will go over it again, but I would like you to make a note of that somewhere. If the zone pattern gives you 60% or more of probability, those are the ones that you have to take notice. So if you have a way of saying, okay, I would like to sell this market somewhere over there, as an example, and you have a methodology that gets you into the market, and the zone pattern that day gives you a probability of resistance in, say, zone number 5, which we're obviously going to carry on with and see. And that zone number 5 is going to be the high zone for the day, which means there will be no close higher than zone number 5 60% of the time. Anything that's over 60%, of course, is a blessing and a bonus, and they do happen. And we will talk about the value of statistics, how many examples over the 10 years, so on and so forth. This will enable you to say, yes, anything over 60%, I get a sell signal, it's worth taking a shot in the direction of the trend. Of course, if it's higher, the probabilities increase of success. Also, if you're looking to take a 2 or 3 day trade, or if you've been away, or if your desire is to add to your short position. Let's say you're a long-term trader and you have established the fact that the market is in a downtrend and you're now shorting the market. This will enable you to add to your position where the odds, or the probabilities if you like, are in your favor of entering the market that specific day, that zone will be your clearly defined risk area, and we will talk about this, 60% of the time. By the contra, of course, that it's 40% of the time it's going to fail. But I am happy, after 20 years of trading, to take the odds when it's 60% to 40%. This, with the leverage position that we are taking in the commodity market and now easing off slowly but surely into the stock market, I'm happy to start trading in areas where the odds or the probabilities are 60 to 40 in my favor. Those of your professional traders know exactly what I'm talking about. I have trading plans that only give positive results, in other words, winning trades 50% of the time. I know traders who've got winning trading plans that are only winning trades 42% of the time, and they still make a very comfortable living for many, many years through money management. This forces you to use money management in the trading. Just by the fact that, hey, say, unless it's 60% back up, I'm not going to take the trade. This is psychologically a very, and I will show you the other way to use it. If it's less than 60%, okay, I may use it, but I will trade much smaller. With my normal trading plan, in other words, this does not contravene your trading plan, whatever it may be. It doesn't have to be mine. It can be anybody's, providing you've done your back test and so on and so forth. This is a statistical backup to your trading plan. This is what this is all about. Okay. And that's the reason why I introduce what is the zone pattern for the day, and we will work with a checklist that enables you to say, yeah, today I will take this trade. And that, for me, is the end result of what we're trying to do. Okay. Now, every page that I will show you from now on is already in the book that you have got. This will be a part, I'm going to change the words and so on and so forth, as far as the approach may be concerned, but this is going to be the probabilities and the percentages are exactly the same that are on the computer, and that will be in my book in June, whatever. Okay. First thing we're going to do is we're going to show how to calculate the zones, and then we will talk about, well, I don't even know if I want to get into that, why these zones are a little bit different from some other zones and so on and so forth. I don't care about that. All I know is that these zones do the job. Okay. Okay, this is not even big enough to encompass it, but this is in your charts, and this is going to be well, you know which page it is. This is page 1 without a page number, but it's chart number 1. And first we're going to do is work out the actual calculation. Of course, the computer does this automatically for you. We are now talking about intraday bars. It tells you clearly, Fibonacci zones for intraday trading. Is this applicable to trading the daily bars? The answer is no, not on the same basis. This is extremely sensitive, and you will see it depends strictly on two different calculations of the market, and it is specifically what I said for intraday trading or entry into a 2 or 3 day trade, or for adding to your position if you're a longer term trader. These are the 3 purposes of this setup, but majority of it is for intraday entry and exit. Okay. And that's why it tells you very clearly so there's no misunderstanding. The calculation, in order to get the zones that we are working with, is dependent on the previous day's high, low, and close. On the left-hand side of the chart, you can see there are 5 intraday trading periods. It doesn't really matter how many periods. This may be, say, the wheat trades 5 45-minute bars, the soybeans, and so on and so forth. We will talk. Somebody asked me a question, how do I divide the trading day? How do I know which is the correct ratio of the number of bars into the trading day? On this particular thing, this is 5 40-minute bars, and this works well for, hello, I touched this thing.
Hit negative.
Okay, thank you. Okay, on this, you can use the 5 trading bars on all the grains, which means bean oil, wheat, corn. Corn is very slow. Certainly the soybeans. This whole concept, as you see, works very well. Well, it seems to do reasonably well, but on a 5-period basis, it means that there is no time period left over during the trading day. I tend to work with Fibonacci ratios. Whatever is, and I ignore Globex, by the way, before anybody asks. And I ignore the night session. I trade only the markets. I may enter and I may exit on the night session, but I may take profits on it, but I don't like to take action because it's like wild shots. As long as the trading constitutes 90% of the total volume during the trading day, that's good enough for me. I will never get the last tick up or the last tick down. That doesn't concern me at all. So if you have 5 times 45 will give you how many trading minutes from the opening bell to the closing bell. You divide it by 3, 5, 8, or 13. That usually gives you the highest probability to show you what defines the support and resistance areas of the daily, which we haven't even talked about, but we will. And I have found that the number 5 generally seems to be the best. 3s and 5s are almost magical in their nature as far as the market rhythm is concerned. 8 will work, 13 works. That's why I use 13 60-minute bars when I'm involved with the cash currencies, and because of the bank involvement, I have to keep an eye on it and work with it, which is London open, New York close. Once again, it's a Fibonacci number, and they seem to do a reasonable job. Okay, what's the calculation? The calculation is we take the high, the low, and the close of the day. Let's say today is Monday. Add the 3 together, divide by 3. That will give me the balance point. This is like the balance in the market. What we will then do is to take whatever was the physical range from the high to the low in price and take 50% of that, 50.50 of the range. And that gives us this line here and this line here, which is marked with 0.50. How do we get that? All we do, if the ranges are say 60 points to the day. Half of 60 is 30. We mount the 30 below from the balance point down to this support line, and the same again the other side of the balance point, which gives us the first resistance line. And this is why this is labeled resistance 1 and this is labeled support 1. Now, the question is going to be asked, why does this work? We will talk a little bit about it, but I don't want to waste too much time. There's been many, many claims. Who discovered this? I own a book by a guy called George Cole that was published in 1936. And in 1936, when he published it, that was the year I was born, he talks about in the book the only mathematical calculation that works in a mechanical way is the calculation that I'm showing. It wasn't exactly the same, but it was reasonable facsimile. He wasn't using Fibonacci numbers, I am, but the concept was the same. High, low, close, divide by 3 gives you the balance point, projected percentage of the previous day's range above and below the balance point. And he says in the book, I do not know where this calculation came from, but he was told by the old-time floor traders in Chicago in 1936. He's talking about the old-time floor traders. So God knows what year he's going back to. So there is nobody that can claim a magical copyright, whatever, on this particular, because nobody knows where it came from. My personal belief is this has a lot to do with hermetic calculations, which some of you may be aware, with ancient geometry, trigonometry, etc., as above, so below, so on and so forth. And I think that's the real reason why it works. There are certain people on the floor of all the exchanges who use this calculation, which gives them a projected low and a projected high, but without the mathematical backup that we're going to have. And you will see when prices approach these points, and we will have many, many examples, 45-minute basis, 10-minute basis, 1-minute, they do react at these points, or they just smash through it. We will try and make it a little bit more of a usable tool because we're not on the floor. Therefore, we have tremendous advantages off the floor, by the way. And one advantage is to think. When you're on the floor, you don't have time to think. You can only react. You can only react. So this is the basic calculation. Where I keep doing this. I must not touch this thing. Okay. Now, as far as the zone calculations are concerned, I will for the moment leave alone the point that says 0.618. We will come back to it. But the only other calculations we need for the zonal calculations, and not this support and resistance bands, which involves the 0.618, is the number 1 above and the number 1 below, which forms support band number 2 and resistance band number 2. And all this is we take the entire trading range of the previous day This is a crazy thing. We can't even get the entire chart into it. Okay. If we take this range and mount it entirely above the balance point, gives us number 1, which is 100% of the previous day's range mounted above the balance point, and 100% of the previous day's range from high to low mounted below the balance point. And believe it or not, that's it. That is the only thing that we have to give us our zone definitions. And there you can see that this is zone number 1, this is zone number 2, zone number 3, number 4, number 5, number 6. What is important here is the realization that zone number 1 has no bottom. There is no bottom to it. Zone number 6 has no top to it. But all the other zones between 2, 3, 4, and 5 have a clear definition of the bottom of the zone and the top of the zone. And what you have to realize by implication and reality is the top of zone number 2 is also the bottom of zone number 3. This is zone number 3. I better write this so we can actually read it. This dumb thing. So number 1 has no bottom to the zone, and number 6 has no top to it. And you will see the implications there as far as breakout concepts are concerned. This is where it becomes important. And this way it enables us to give a clear definition where one zone begins and another zone ends, except in zone number 1, because we cannot physically say, hey, the market, once a breakout has been achieved, it will stop here. It can go heading south for another 300 points. And we will show you, I will show you hopefully, how we actually utilize the information in zone number 1 and zone number 6 to our advantage where breakout concepts begin. So this is the simple explanation, and it is a simple one. And the interesting thing, although this has nothing to do with zone analysis for intraday trading, I utilize exactly the same calculations when I do the daily, weekly bars as well. Not the zone trading, but just to define the zones for support and resistance when I do daily bars. So if I just said to you, this is not 1 day's trading here. This was Monday, Tuesday, Wednesday, Thursday, Friday. So we get the week's high, the week's low, the week's close, gives us the balance point for the next week. It gives us, we take 50% of that, the week's range, and it gives us the week resistance 1, and we swing it below, gives us the weekly support 1, and so on and so forth. In other words, this is just by the by. We'll come back if I have time a little bit to this when I work with the computer, that the definition of Fibonacci support and resistance is always 1 time period up. And this is, and I don't change the calculation just because I'm changing my time period.
You find out what works best with 5?
Well, there are 5 days to the trading day, to the trading week: Monday, Tuesday, Wednesday, Thursday, Friday. I have tried it going from Tuesday to Tuesday, Wednesday to Wednesday. Why did I try it? And this is what experimentation and thinking is all about. And that's why Richard Dennett has become a researcher. Because Friday night, a lot of people throw in their position. Therefore, they just won't hold a position over the weekend. Okay? So the close is not a real close. If it was, everybody still had the position, the close would be higher, which alters the support and resistance bands, not substantially, but it alters them a little bit. So I tried going from Tuesday to Tuesday, Wednesday to Wednesday. It does make a difference, but not sufficiently for me to stand here for 2 days, wave my arms around and teach you a new trading concept. You just have to be aware that on Friday night, there will be a little aberration, slight, not too much, on the calculation because of people dumping their position over the weekend. Yes, sir? Of course, of course. This is, the next 2 hours will be consistent. We're going to have a tea break now, and when we come back, we're going to focus entirely for 2 sessions on the zone trading, because this is very important. And of course, at the end you can say, hey Klaus, looks good, but it's no interest to me. That's fine. I have no problem. But those of us who know the value of it will use it. Tea is served outside. Trading. Just to review, before we went for the break, high-low close divide by 3 gives us the balance point, which is marked over here with the letter A, but it just says balance point. 50% of the previous day's trading range, above and below projected. The balance point gives us resistance 1, support 1, or we take 100% of the previous day's trading range, gives us the resistance, point number 2, which is the entire trading range of the day, projected above the balance point. If you project it below the balance point, that gives us support number 2. What we will be talking about is not just the zones, but how to incorporate them into trading concepts, be it your method or my method or anybody else's. And really what we're going to find that there are 5 areas, what I call 5 action points, which are in fact the support 2, support 1, the balance point, resistance 1, resistance 2. Very simple concept. These are the areas from the trading plan point of view, and not from the zone analysis as a standalone system, to combine the 2 ideas to make it really useful. Okay. The entire concept that we are working with is the zonal divisions tend to represent zone number 6, which we saw is immediately above R2, has no limit, is strong upward price momentum. Zone number 5 is moderate upward price momentum. Zone 4 and 3 are congestion areas. Zone 4, which is just above the balance point over here, this area is a congestion area, but with an upward bias. So the congestion areas are the first zones either side of the balance point. But with an upward bias if it's in zone 4 and a downward bias if it's in zone 3. We're going to get into that in greater detail. Zone 2 is moderate downward price momentum. And zone number 1, which has no bottom, if you remember, is strong downward price momentum. How do we define the zone patterns is as follows. And what does this mean? Forget about, we're not concerned with the top of page number 4 in your book. We can leave that alone. We can cover that at home. What it tells you is pretty clear. As one becomes conversant with the zone designations or the zone patterns, it becomes natural to organize trading days according to zone price movements. In other words, when the prices move from zone to zone. The concept of zone price movement lays the groundwork for developing the zone patterns themselves, which are zones reached, zone support, and zone resistance probabilities. This point we don't have to labor too heavily on. Push the wrong button. Technical analysis in its broadest sense deals with the examination of historical price relationships. That's what technical analysis is all about, by the way. These include range expansions and contraction relationships, high-low relationships, which gives us the balance point, so on and so forth, and gives us the third is the one that we will be talking about here, is the close-open relationship. This section presents a relatively new concept of zone relationships referred to as zone patterns. Zone patterns incorporate the concept of the range, blah, 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 blah. We're not concerned about that. What we're concerned about is how did we define the zone pattern. The zone pattern is the previous day's close, i.e. the closing zone of the previous day. Which zone through 1 to 6, and the opening zone of the trading day. Now, I have to make this very, very clear, otherwise we're going to have a total misunderstanding. What we are concerned about is the previous day's close and today's open, which is made reasonably clear on chart number 6 in this middle section, but I will show it here so we can see exactly how we define our zones, i.e. the zone patterns. And this is what this is all about. Zone pattern. I don't know. Page number 5, 6, or 7 in the middle. Okay. Okay, well, I'll give you a photocopy when the work is done. Chart number 5, it says on it. It's there, it's in your book. Okay, let's press on. It doesn't even really matter, as long as you understand what I'm trying to show you. Okay. Let us just work on this trading day here and this trading day here. Okay? Right. What we're looking at here, this is the balance point for this trading day. Okay? Which is day number 4, 10/16 on this chart. Day number 4, it tells you at the bottom. And you can see that this is not a favorite gadget of mine, by the way. On day number 4, you can see that we had a very big range as far as the zones were concerned and what we have been looking at. So that was your balance point. This was the top of zone number 4. This was the bottom of zone number 3. And from here downwards was zone number 2, so on and so forth. Zone 1 and zone 6 are not shown because they're far above and far below the chart. So what we will be looking at is that on this day, we closed in zone number 5. You can see it tells you zone number 5. Okay. The last bar of the trading day, we're looking at, I believe this is crude oil, it doesn't matter. Yeah, this is crude. For crude we have 1, 2, 3, 4, 5, surprise, surprise, 5 bars to the trading day. I think these are 65-minute bars. And we can see that we're closing in zone number 5. And the zone is circled. So when you close in zone number 5, the first half of your pattern is already fulfilled, i.e. the close is number 5. Okay? The close is in zone 5 because it is there and you can see it. You can do nothing with this information until the next day opens. But instantly on the open, you can see that the price opens in zone number 4, which I've just circled. This red doesn't show up very well. Okay, I'll do the green, which I think will be better. Can we make this light a little stronger, you think? It looks a bit not easy, but if we can't, that's fine. You are okay? Okay. So this opens in zone number 5, zone number 4. So now we had a close in number 5 and an open in zone number 4. So the actual pattern that we will be working with for this entire day, and it does not, the zone pattern does not change. This pattern is what gives us the probabilities every single day instantly on the open. And we're going to go back to this. So the zone pattern that we are looking at for that entire day is 5 close, 4 open. And that's it. Now, what we can see is if we have this particular 5-4 pattern. In your book you already have, this is crude oil, and before anybody asks for the page, there's no page number because it's rough parts of books. You just have to find crude oil yourself, but you don't even have to find it yourself because I'm going to put it up on the screen. But you have it in your book. It comes between whatever. Between natural gas and that's it. Okay. Now what you have to realize, because we have 6 zones for the close and 6 zones for the open, you have 6 times 6 is 36 different probabilities. Okay? You don't have to drive yourself nuts about this. The computer calculates this for you instantly. But if you don't want to, all the combination probabilities are already in the book that you have with you. So if we have to look for the crude oil, I'm going to try and find you the exact example. We closed in zone 5 and opened in 4. Okay. There we go. Okay. This is what the computer looked at. And we're going to firstly widen it, and then I'll go so you can read the numbers. Otherwise, it's very difficult to read them. On these charts, and this is how the work was originally done before we computerized it, you will see here on this crude oil page, Zone 5 close. It's in this fourth from the top of the page. You don't even have to worry too much about that. This will tell you that for that day that we were looking at, we had a close in Zone 5, and opened in Zone 4. The instant this happens, the computer checks its memory banks and does a scan over the entire 10 years in a split second, by the way. There is zero time lost, as you will see. Well, it takes a split second, so that's just some time, but it does not affect your thinking. What I want to do is I want to show you what the computer does, and then we'll show you how we use it. So you feel comfortable, and it'll stop certain questions being asked, which I know will guarantee to come. People who are the professional traders and have a knowledge of statistics, I will forego and forejump their questions. Over the first number that you look at is this number here on the right-hand side. Okay? That number says 196. Okay? That's this number here. That means that over the last 10 years of looking at the crude oil analyst, by the way, it's now not 10 years, really, if I've updated to 97, the one on the computer is 13 years. The change was almost minor, as I explained to Sean. What this means is that this particular zone pattern of in the crude oil, because this is what we're looking at, don't forget each one has its own stuff. Okay. On the crude oil here, it occurred 196 times. Now, those of you know a little bit about statistics will know that in order any statistic to have some kind of validity, we need usually a minimum of 30 occurrences. Statisticians tend to view any repetition of facts or analysis that occurred less than 30 times with a little suspicion. Why the magic number is 30, I don't know, but if you have statistical friends who are statisticians and work with statistics, they can explain to you the reasons for it. Myself, if it occurs anywhere between 25 and 30, I'm usually comfortable with the result. You will see as you go through this that sometimes things only occur 4 or 5 times in a 10-year period. I would be a little hesitant to put my money on something that occurs only 4 or 5 times. In other words, I will not regard that as a valid statistic as far as this particular concept is concerned. So now we know that this occurred 196 times, and 196 times in 10 years gave us, this was a 5-4 pattern. So it closed in zone 5 the previous day, and it opened in zone 4 that day. Okay. So what? And this is what this exercise is all about. What, when you have this particular zone pattern in crude oil, tells us is, and we go to the other side, we have to make it a little bit, that's better, fine. I think everybody can see it. with a 5-4 pattern, which is involving this section, okay? We have 3 bits of information based on 196 occurrences of the identical pattern over a 10-year period of this particular commodity, which happens to be crude oil. But it doesn't matter. You could be looking at IBM, or you could be looking at cash currencies or soybeans. It doesn't matter. Each one, of course, is statistically tested for that particular, not just pattern, but that particular commodity, because each one behaves in a different way. So what do we see? What is the first question that I ask? And this is the reason I gave you, or I handed to you, this particular checklist, which eventually, hopefully, some of you will use, some of you will just rely on the computer, and some will not use it at all, but that's fine. Because the first question would be, what is the zone pattern? And we have already defined how the zone pattern is set up apropos the close and the open of a specific commodity. Okay. The first most important information as far as I'm concerned is by virtue of whoops. Okay. The most important point here is how frequently is a zone reached. So when the price is open in zone number 4, by virtue of the fact that it opens there, of course we know immediately it has to be reached 100% of the time. That's a given. If it opens in zone 4, every time because the zone pattern is 5 closing, 4 open, if it opens in zone 4, of course it's going to be reached 100% of the time. So what do we look for after that? And we remember what we're looking at here for the next day, for the same day after the open has occurred, what percentage of the time are the other zones going to be reached? And this is where we start thinking of our trading plan. So what we look at here is, and we see that there are 2 high numbers here. And remember what I said, if prices go towards the 60% area and upwards, I pay attention. 50, 55, 54, 56, 57, depends on the trading setup. I take notice, but not too much. 60 and over, I'm on full alert. 70 and over, I am wide awake. And at 80, I'm jumping up and down in my seat, guys. Because that's how I realize the potential exists for reasonable action in the markets. So what do we see? We see that, I will stop having to do this silliness. There we go. Not so good. There we go. Upper. Okay. Right. I think it may be easier if I sit down a little bit and I won't touch this. Okay. What do we see? We see that zone number 5, if prices open in zone number 4, which we're going to show you in a moment, the actual chart we were looking at, 61% of the time it will reach zone number 5. And 65% of the time it will go to zone number 3. So we realize that zone number 5, as far as probabilities are concerned, of the zone being reached, which is at the bottom of the chart, this is the first thing we look at. What frequency is zone number 5, which is the highest frequency? So we see zone number 3 and zone number 5 are the two highest frequencies. Do we wait for any other information to come in? The answer is no, not yet. Because we see the moment it happens on the open, if the prices do reach zone number 3 first, and we will talk what's hit first or second and the consequence thereof, that we see that if prices do reach zone number 3, which is reached 65% of the time, which is important information for me, then I see that this, and now remember, zone number 4 please remember this. If we opened in number 4, which is we open somewhere in this zone here, okay? So this is opening above the balance point. Let's say it opens somewhere over there, okay, where I've shown it. So the moment it opens, it tells me that I have a 65% chance of it going down to zone number 3, which is sitting below me. So 65% of the time, given the zone pattern, the prices will head south at least into zone number 3. So this is job number 1. This is a number 1 type information. That's 65% of the time, prices will head south into zone number 3. This already is important enough to realize, 65% of the time it will head to zone number 3. This is important enough to realize that if you have a position on from the previous day and you are short, as a comfort zone comes in, so to speak, that 65% of the time, sometime during the trading day, zone number 3 is going to be reached. So the odds are 2 to 1 approximately in your favor that your short position is reasonably healthy. This is looking at it on a very simplistic level. But what is the next piece of information to look at? And the next piece of information to look at is if zone number 3 is reached 65% of the time, what will happen if that zone is reached? And when you look horizontally, it will tell you that if the prices reach this zone number 3, which happens 65% of the time, 68% of the time when it is reached, it's going to be support. What it means is as follows, that if the prices reach down into zone number 3, 68% of the time they will close in that zone or higher. Close in that zone or higher. In other words, only 32% of the time, once that zone is reached with this particular pattern, will the price close lower. Once again, the odds are in our favor. I will talk more about how to combine the zones as far as support and resistance is concerned, but that's enough for the moment. So once you have this situation, if you're doing intraday trading, and let us say that you had a short position from the night before, you would seriously consider that zone number 3, once it's reached, may not be a bad place to take some profit. Because 68% of the time, prices are not going to close any lower. What's the point of holding it? Or at least partial profits can certainly be taken, and this is one of the reasons why I advocate multiple contracts for trading rather than a single unit. that under these circumstances, when I'm trading a 3 lot or a 6 lot or a 9 lot or a 300 lot, because I trade in multiples of 3s as a habit already for many years, I will take off 1/3 of my position in the zone that gives me a 68% support. I don't think, I just watch it a little bit, I take my profits, goodbye. We will work it into trading plans, but unless I show you what is the benefit of the zone, there's no point in working with my trading plan unless you know how to utilize the zones by themselves with your plan or anybody else's plan or mine, whatever the case may be. So that is the number one. Number two, you know that if that zone holds, which is 68% of the time, 61% of the time, which is the next probability, it will go to zone number 5. And if it does go to zone number 5, in other words, prices went down here and now they start traveling back up, and of course it could be a little bit lower, it could be a little bit higher, it even could go to the next zone, because when it says 68%, it means that that 68% will fail 32% of the time. So it doesn't mean that 68% of the time is going to come down to the tick to support number 1 and hold there and not go back up. But you'd be surprised how often that happens. But that's another story. That's why we need technical signals, where to get in and where to get out. So let us say it doesn't matter if it goes here, here, or here, but once the prices reach back up to zone number 5, over there, we will know that zone number 5 holds as resistance, because what's the third line from the bottom? It tells you here zones reach, zone support, and zonal resistance. So what we can see is that if the prices reach zone number 5, 68% of the time, that's going to be the highest zone, and there'll be no close higher than that. So if for whatever the reason, and we were going to get into detail on this, you bought down here, or well, I don't want to go into that. Let's say you bought for whatever reason somewhere around here. When it is reaching up to the zone number 5 over here, which we know is resistance 68% of the time, that's a reasonable place to take some profit. In fact, if the market is really struggling and I'm in a congested area, and it is, and we will talk about it, a contra-trend trade, I just take all my profit there, because with contra-trend trade, folks, I told you, if you think that you can use the same rules for trend trade and contra-trend trades, you're dreaming. Also, what happens when you take a contra-trend trade and you're taking against the trend, my estimate is that only 3 things can happen. Majority of the time you're going to lose money. A minority of the time you're going to take a small profit, and you have to take your profit sometimes quickly when you have contra-trend trading setups. And now and then, and we don't have the time unfortunately to go into this, that's a full day's workshop on its own. Now and then you will have a home run on a contra-trend trade. But in my opinion, if you hit 1 out of 10, like 10% of the trades on contra-trend basis ends up as a home run, you're doing great. Usually it's less than that, if you take every mechanical trade on contra-trend basis. Most of the time it's less than that. So if you're taking a contra-trend trade, this is not a bad place to take some profit. Also, don't be surprised if for whatever the reason you decided to buy the market here, excuse me. If you decided to buy the market here, wherever, don't be amazed that the 68% has some validity, and the market just stalls out in this zone. It'll mess around, they go up and down, and it closes maybe somewhere around here. It has fulfilled its job. The only thing that is not on this handout here, because when this was made, the work was not finished, and that's only on the computer program at the moment, is the probability of where the price will close for the trading day. And this was not left out on purpose. It just happened to be a fact of life that to prepare, I don't know how many hundred pages there are here, printing both sides, I did not have a chance to print out all the daily close probabilities. But when I switch on the computer, you will see. Those of you who really want that, I will supply it to you as a printout in the next couple of weeks, if you really want it. But if you're not going to trade intraday, I wouldn't concern myself too much about it. So this is what the computer looks at in order to define how it works as far as the internal mechanics are concerned. Some of you have told me that you have done some work as to if the close is higher than the open, what percentage of the time it'll go to da-da-da-da-da-da-da. That research is fine. There's nothing wrong with that research. But what you're going to find as we work with the computer, the sophistication of what I'm showing you, I'm not saying validity. I'm not questioning the validity of any other research. Please don't misunderstand me. But the sophistication and the usability of what we're talking about here is in a different ballpark altogether. What I'd like to do now is, for the moment, go over to the computer and show you a more or less current up-to-date. I'll show you wheat, I'll show you bonds, I'll show you S&P. We'll go through a number of things, and I don't know why, but my bar charts are looking white and not yellow, but I am not here to question the mysteries of computers from multi-color LCD projectors. Okay. But what we'll do, do I have to fiddle at all, Derek? Okay. The blessings.
Can you set your computer to have external one?
Okay. There we go. Okay. We are going to have a little look at I'm going to try and bring up the wheat 45-minute basis, and we'll see how this works. Okay. Right. Everybody can see that nice and clear? Good. When you have the probability zones built in, you utilize exactly the same Fibonacci zone button that you use for everything else. Now, at the moment you can see that there is, and not too well, okay. What we're going to work with first is I have to change the colors because some of the colors are wrong, so bear with me for a split second. You can use any colors. I just happen to like the colors that I've been using for years, and it will give us a better opportunity to see what I'm talking about. Okay. We are going to be looking at this particular day, and what in fact happens is if I bring up the scroll bar, it scrolls back bar by bar. So what you can see here is as follows. The closing zone for this day that we finished with was the previous day closed in zone 4, and the day that we are looking at here opened in zone number 4. So this was a 2-4 pattern. Now when the market opens the next morning, please watch in this particular, what I call, this is the zone matrix, gives you all the information that you need. The right-hand side, you see a zone meter. And what in fact happens when I switch on the tick player and the prices move from zone to zone, two things change. Number one, in the zone matrix, the zone itself is highlighted, and also the zone meter on the right-hand side shows you by highlighting it, and you can see there's a little white ball here. That is the last price in the zone itself. So not only is the zone highlighted to blue as is shown, but the closing price happened to be over there, and that closed at around 345 and a half. And if I go to the bar, the close was correct, 345 and a half, and that's reflected in zone number 6, of that day. And it tells you the zone. We don't see it very clearly on the chart, but on the screen you see it very well. Do you think we could fix that, Derek? You see, we can't see here. You can see the numbers. I'm losing stuff on the right-hand side of the screen here. And these numbers are lost, and we can't see the zone numbers in the middle here. Ball here, it's like follow the bouncing ball that just rides up and down, reflecting the actual price as it changes tick by tick. Okay? That's little white ball over there. That's better. Now we're getting the other stuff. That's cool. That's fine. Okay. Yeah, that's better. Okay. Now the other thing that we can see is that the moment, let us go the next day, you can see what has happened. The next morning, when the price is open, and of course I'm only showing you the very first bar of the next trading day, which is the first 45-minute bar, but it gives you this information in here immediately on the open instantly. And when I switch on after lunch, we're going to work with the program with the tick play. You'll see the moment the first tick comes in, you get the following information. Number one, We know it closed in zone 6, which you saw yesterday. Today we opened in zone 4. There. Now it's already in zone 5. But the original open, look where it is, in zone 4. You see that? Now, by the time the prices have reached, of course this reflects the immediate zone position, the first bar reached into zone number 5, and that's why zone 5 here in the matrix is highlighted. But if you go back, and we can alter this, no, I don't want to do that. So what we're looking at is the reality of the last price, which was in zone number 5. But we opened in zone number 4, which is this zone here, which I'm showing you. And when the open takes place, this highlighting, which is now in zone 5, of course is in zone number 4. And the information when it opens, and of course because it opens in zone number 4, it's reached by implication and reality 100% of the time. If it opens in zone 4, no matter how often this occurred, it will tell you, okay, this zone is reached 100% of the time. And what is the information we look at? We look at the information that says we took to the left and we look to the right. Zone reached, it tells you immediately the bottom line here. We can see that zone number 3 is reached 68% of the time, which is somewhere down here between this area and this area. Now remember, the zone is fixed for the entire day, the zone pattern or the zone definition. And you always know that zone 3 is going to be between the balance point, which is here, and the bottom of zone number 3 is over there, which is support 1. Okay? This is support number 2. I think I'm going to change the color of support number 2 to purple, which is easier to see. And also on the balance point, I happen to like an arrow. Okay, well, it's sort of purple. It's like a ready purple. This is support number 2, support number 1, balance point, resistance 1, resistance 2. These are exactly the lines that we were working with in the beginning. Okay, so we know immediately on the open, when prices open on this bar, and the open was 346 even, we knew immediately there was a 68% chance of this being reached, zone number 3. And zone number 5 is going to be reached 57% of the time. Okay? So those are the two highest numbers that we're interested in. And if prices do reach zone number 5, we can see that there is resistance, because it's the upper zones we're looking for resistance, the lower zones below the balance point we're looking for support. We can see that, wow, 70% of the time prices will not close higher than zone number 5. So somewhere in this area, and we will talk a little bit more about it, prices will not close 70% of the time in a zone above zone number 5, which is over at this point, and you can check the price. The high of zone number 5 for that day is, excuse me, I lost it. It's in the bottom right-hand corner, which I can't see, by the way. I am not sitting at the correct angle because we are filming this thing. So the bottom of zone number 5 is 347 and a quarter on the beans. This is wheat, excuse me. So we know that if this zone is reached, zone number 5, and we can see it, that in the first 45-minute bar, we have already reached zone number 5. If I have a number that says, hey, 70% of the time this zone 5 is resistance, perhaps it's time to do one of two things. Either to look to sell it, or if you're long, perhaps you should take some profits. In other words, you're thinking. We're not even talking about theory here yet. There are all kinds of theories involved with the markets. There are people who like to buy support and sell resistance. There are people who like to do exactly the opposite. And floor traders tend to do the opposite. They will buy new highs and sell new lows and so on and so forth. With zone analysis, you have an option to do either. But I don't want to go into the theoretical. We keep on the practical side what information we can use. Did we know that zone number 5 or zone number 3 is going to be reached first? No. There is no methodology in the world that I've ever seen, including these statistics, that can tell you which zone is going to be reached first. But you will see as I go through various commodities and contracts that there is a habit for the highest and the second highest to run as a pair. Once again, no holy grail offered or promised. Nothing works 100% of the time. But there is a tendency, majority of the time, for the two highest reached frequency, highest reached, to work in tandem. So we know that if the zone 5 is reached, which it says 57% of the time, 70% of the time there is going to be resistance, which is a nice combo. I would have preferred to see 60% here and 70% there, but I'll take 57%, providing the resistance is really of some consequence. Do I know if the resistance is going to fail or hold? No. But I know 70% of the time that will hold as a zone. Something that I must take notice if I'm going to take profits on my short, or I'm going to sell or look to sell in this area. This is the third point here is we look at, there's a line in turquoise color or pale blue if you like, but to me it's turquoise. And it says day, and this is the information that's not on the printed handouts. And it says day, and the line underneath it says close percentage. And what it tells you is today, second day, third day, fourth day, fifth day. And this is what I was talking to you about. What it says to me, that when we have a 6-4 pattern, which is what we have, it closed in zone 6 of yesterday. And if you watch my little guy at the top, see the arrow, and we opened in zone 4 today, 48% of the time we're going to have a higher close than the open. This is not a big number, but I know that 52% of the time the converse is true, because the program always looks at what percentage of the time are we going to close higher. So you know that if it's only 48% of the time higher, 52% of the time we're going to have a lower close. And if you're trading big numbers, statistically, this 1, 2, 3, 4, 5% doesn't make a difference. You'll see it does when you work with it a little bit. And this is, of course, included in there's no extra. This is part of the whole deal. Okay, so let us now go, and now we'll go one more bar to the right and see what happens. Now, this happened to be the last day that I could do before the workshop. In other words, I need always 2 days. And we can go to any day that you like on the wheat, the beans, etc. And we will give many examples. What I'm saying is, I'm not picking examples to show you that it works. what I may do, what I sometimes do privately when I have 2 or 3 students or something like that, I just say, shout a date. Pick a date. We go to that date, see how it performed. Pick another date. We'll go to another date. So in other words, the system must hold up not on just pre-selected days that look very nice. The system must show you when it's crapping up also, if you'll pardon my French. In other words, just to show winning concepts is nonsense. Because if something works 68% of the time, 32% of the time it's going to fail. How do you handle when it fails? This is the crunch. This is the crunch. Okay, so we see that in the next bar, we went back to bar, we went down into zone number 4, which is where we opened. And look what has happened. I'll just flash back to the previous one. This shows you that we were in zone number 5. And when we go to zone number 4, and this of course happens in real time, and this is what this is all about, by the way. Real time, real time, real time, folks. Immediately 2 things happen. Number 1, the zone meter highlights it and it shows you where the price is. And this little ball goes up and down tick by tick within the zone. But you are aware that, hey, you're in zone number 4. And the same thing happens in the matrix, which showed you all the probabilities, etc. That zone number 4 is now the zone that you're trading in. What is important here is the probabilities don't change ever during the trading day, and the zone pattern doesn't change. You don't have to drive yourself mad. A 6-4 is a 6-4 is a 6-4. And no matter what happens during the trading day, that is constant. Because unless you have constants to measure against, how can you have statistics? It's impossible. But we now see that zone number 5 did in fact hold as resistance and drove prices back down into zone number 4. What helped the prices? Now we have to start thinking from trading concepts. The Fibonacci resistance band, which is over here, which I didn't talk that much about, but this was the 0.5, which is the top of zone number 4, and this one is 0.618 of the previous day's range, and this little area forms a resistance band. These bands, in fact, become very useful tools as far as trading is concerned. And when we have a trading band that is also in the vicinity of a 70% resistance area, that's marvelous and useful information for trading concepts. So let's go to the next bar. Neutral inside bar. We're still in zone 4. Zone 4 is still highlight. And we go to the next bar, zone number 4. Once again, it attempts and it tries to penetrate the Fibonacci resistance band over here. But we're still in zone number 4. And the last price that was recorded, because this is 45-minute bars, the close of that bar, you can see, was in zone number 4. But as this bar was live, when this penetrated in live format, so to speak, into zone number 5 gets highlighted in blue, and the little ball also enters in zone number 5. So visually, you have constant information coming in a usual manner. So if you're trading two different commodities, and you know in the beginning you say, okay, today is we have a 70% probability on the wheat, but only 40% probability, and I'll show you how we can handle it. And in the beginning, I don't suggest that you trade 2 intraday contracts. It's not easy to do. Focus on one thing depending on the depth of your pocket and also your targets that you want to be working with as far as your own personal agenda is concerned. As I said, if you have a $25,000 account, you have no right even to look at the S&P. Even for information, it's a waste of time. You have to trade within the confines of the depth of your pocket. So now we go into zone number 4 again, and we go now to the last bar of the trading day. Before, this was the last day I could actually put in real-time data with the tick pair, because Carlos had to come down, fix it, etc., etc. And we see that this day is the 18th of November. So that's reasonably up to date, considering that the workshop started on Saturday. So what is the end result of the last bar of the day, which is also the close of the day? The things that we will look at is, number one, when the prices went to zone number 5 first, did zone number 5 hold as resistance for the day, and did we close below zone 5 or certainly in zone 5 at the highest? The answer is yes. The probabilities on this particular day, on November the 18th, the probabilities kept their promise, and this is a phrase that I use, that the 70% resistance of zone number 5 held nicely, and certainly there was no danger for me that on this particular trading day we would be closing above zone number 5, and the 30% business would happen, because if it's resistance 70% of the time, 30% of the time you're going to fail. But it was a 2-to-1 shot in my favor. And I'll take a 2-to-1 shot in the markets any day of the week, because this tends to define, and those of us who are professional full-time traders really will know what is the opportunity that we are working with here. The second thing is, was the close of the day higher than the open? The answer is no. The close was just a little bit below the open. Surprise, surprise, because only 48% of the time would it close higher. So 52% of the time it closes lower. So the resistance kept its promise, and the on-close probability also kept its promise. This is your first introduction how to utilize zone concepts for intraday trading. I have to stop talking now because I only have 1 minute left.